Ladies and gentlemen, welcome to the IISS for a talk by Professor Eric Jones of decisive Bologna, one of the best gigs to have anywhere, I think, on Europe after the Greek debacle. I cannot help but quote our trustee, Bill Emmett, who, writing in the FT this morning, said, "We are in an interval during the long Greek tragedy, in a gap between the wailings of the chorus, but still far from the end." So this is a good moment to ponder one important point about the politics of the Eurozone. There are indeed many points to ponder, not least whether Grexit is still a possibility, and indeed Brexit in turn, whether the euro is in a structural situation where some of those questions around imbalances are any closer to being resolved, or whether they will be ever, and then broader questions about the EU's cohesion, its role within Europe. So it's an excellent opportunity for Eric to give us his thoughts on these points. As those who read the Survival blog know, he's a frequent contributor there, contributing editor to Survival. So he'll speak for about 25 minutes, 30 minutes, and then we'll open it up to questions. I look forward to a good discussion. Eric.
Super. Thanks a lot, Nick. I really should thank Nick and Dana Allen as well, because they've been allowing me to sort of publish these ideas in progress as this crisis has been unfolding. And we've been doing pretty extensive coverage in the Survival blog of what's been going on since January, when we decided that this was an issue that we were going to have to focus on quite acutely. This work is important to me because I'm under contract with Polity to deliver a book on what's wrong with the euro area and how to fix it. And if the euro area would just calm down a little bit, I might be able to finish the manuscript. So I'm hoping that you'll help me make progress on that today. That said, we have moved into a period of relative calm. I think that's important because when we organized this event, it wasn't immediately obvious that we were going to do so. We organized this event just prior to the dramatic weekend when the deal was reached between Greece and its creditors to discuss a future deal. And we timed this event to coincide with the possibility that Greece might not repay the European Central Bank the money that it had to deliver in compensation for the bonds that were going to mature on Monday. So the fact that these bonds have matured, that the Greece has been able to repay its arrears to the IMF, that the situation seems to have stabilized and that the Greek parliament seems to be playing its part. Pierre Moscovici has just tweeted out that everybody is playing their part right now. Seems to give us time to reflect a bit about what's going on. And I think that's a useful exercise, probably more useful than discussing what we should do with a Greece that has no banks. So I'm glad that the alternative reality is not the one that we face. Now, Nick's given me like 30 minutes to talk. I don't think I've ever managed to stretch 30 minutes, but I'll see what I can do. And I want to make 4 points along the way. The first is about the nature of the crisis that we're in. I want to argue that this is not a normal crisis in the European context, and that's going to be important in order to understand why a lot of the easy illusions that Europe always progresses through crisis are probably based on a category mistake, right? This is a different kind of crisis from the ones that we've seen before. The second point that I want to make is about the response that we're seeing. It's a response that's evolving both within the institutions and within the more powerful member states. This is a very predictable response that reflects certain knee-jerk reactions whenever we come into this crisis type situation, but since, as I've argued, this is a different crisis from the kind that we faced in the past, this predictable response is probably not as useful as it might seem. On the contrary, I think it's going to be counterproductive. The reason I think it's going to be counterproductive, this is the third point, is that I think we need to think about Europe differently when we face this kind of a crisis. That's the blog post that we put out, I think, Monday? And we need to focus on enhancing Europe's resilience, its sustainability, and I'll talk a bit about how I think we can do that. Obviously, this is a somewhat complicated argument, and so the fourth point I'm going to make is that we have to find some way to express this argument simply. Because the Europe that we have right now is not going to be sustainable if we can't get the broad population of all the member states to buy into it, and we're not going to get them to buy into it if a bunch of pointy-headed academics like me come out and talk in very complicated language and don't say anything that to them makes sense, right? Which is not to be condescending, it's to suggest that we have a tendency to take the complicated and make it even more so when we should be making things simpler and easier to digest, and that's where I'm going to end the conversation. But let's start with why this is not a normal crisis. You see, historically, and Europe has experienced crises in each decade since the end of the Second World War. Historically, whenever we've experienced a crisis, we've actually seen progress in some other dimension. The collapse of the European defense community in the 1950s ran alongside the development of the European economic community. In fact, the program for the creation of the common market was introduced into the debates about the European defense community precisely to sabotage those debates by the Dutch foreign minister of the day, and to leave on the table a well-articulated discussion of what a common market might look like as a means of resuscitating a very different conception of Europe, one that was more favorable to the Dutch at the time. We saw a crisis in the 1960s with de Gaulle and the nation state, and there was an argument that Europe's supranational existence had come shuddering to a halt. But at the same time that argument was unfolding, we also saw the greatest progress in terms of legal integration with the doctrine of direct effects and the supremacy of EU law. So we actually saw the foundations of the Europe that we have today emerge alongside that crisis, and one could argue, therefore, that crisis and progress coincide in many respects. Now, I could do this march across the decades and show each crisis that we've faced and the progress that was made along the way. And what you see, the sort of characteristic feature, is that we always get crisis, but it's always discreetly contained in some policy domain. It doesn't seem to spread from one domain to another. And there's a reason why, and that is that integration is actually different in different policy domains. The way we think about the participation of other member states. For example, solidarity as a concept means something different when you're talking about market relations or foreign and security policy. Market relations, solidarity, should be understood as everybody agrees to abide by the same rules, but everybody abides by the same rules in the market. That's a solidary market. That's a competitive market. But that's not how solidarity expresses itself when you face an existential threat. There you might argue the enemy of my enemy is my friend. These are very different conceptions of solidarity. Similarly, with distributive institutions, if you're going to talk about solidarity in that context, it's not everybody follows the same rules. It's some people need and others have, and there's a redistribution from the haves to the have-nots that takes place. And that kind of solidarity is different again. Now, understanding these differences in solidarity, which I wrote about in the Journal of Common Market Studies, and be happy to provide the reference if you're interested. Understanding these different notions of solidarity makes it easy to see why we could have a crisis in one domain, foreign and security policy, that doesn't spread to another. I may not believe that the enemy of my enemy is my friend, but I may accept that everybody can abide by the same rules in the common market. And that's what we saw in the 1950s, and we can progress along with each decade and show how different conceptions of solidarity came into play. What defines this crisis is that we're seeing contagion in one conflict spreading to all conceptions of solidarity. The decision to isolate Greece and to threaten its membership in the European Union in such a profound way is unique. It's never happened before in the history of European integration. They've never isolated a member state in that way and put it to such an existential choice. And that's not the first time that this has happened either. I would argue Cyprus faced a very similar existential choice about its relationship with the rest of Europe when it was confronted by the ECB with the potential collapse of its banking system in March of 2013. That's another article that we have in Survival. Having said that, this kind of existential crisis really does tend to pollute the whole nature of European integration because it suggests that no pattern of solidarity appertains anymore. That it's likely that the Greeks simply are not acceptable as members. And I find that challenging to the conception of Europe that we've had to date. It's very different from the crises that we've seen in the past. Nevertheless, the responses that we've seen in reaction to these events are all very predictable. From the institutions in the Five Presidents report, this is not a response to the discrete events of a particular weekend. This is a drawn-out response that's been evolving over months. It's a very detailed blueprint that one could derive quite easily from a number of different economics textbooks, particularly economics textbooks that describe the theory of optimum currency areas and that lay out or articulate the kind of institutions that are necessary in order to stabilize those relations. And so you'll see, for example, in the Five Presidents report, a somewhat strong plea for the creation of common or shared fiscal resources that will stabilize incomes from different parts of the monetary union. I always joke with my friends who are economists about this. One friend in particular who works here, Paul Grauer. Paul is one of the great monetary economists and wrote the textbook on monetary integration. I always say to Paul, you come from Belgium and you were a senator in the Flemish Liberal Party that argued for the decentralization of fiscal institutions. And yet you advocate at the European level the centralization of the same institutions you wanted to dismantle within your own country, right? You cannot tell me that this is a sustainable equilibrium, that we should centralize fiscal institutions. Indeed, and I'll get to this somewhat further on, there's no justification for centralizing fiscal institutions that we can find outside of a theoretical framework that actually has fairly precarious empirical support, and I could explain why that's so. In any event, the argument about the need for fiscal centralization and the arguments that are made in the Five Presidents Report are useful, but they need actually to go further and in a different direction. They need to go in a different direction that emphasizes much more the banking union and the institutional preconditions for successful financial market integration, and to ignore in many respects a lot of the conventional wisdom about what a single currency requires per se. That's an argument among technicians. The point I want to make about the Five Presidents Report is it's very predictably a technical solution. By contrast, the German preference seems to be multi-speed Europe, where there are some countries that are allowed to progress much more quickly and other countries that are relegated to a second tier. We can find echoes of this in the Schäuble-Lammers paper that was issued in 1994, and it's not surprising to me that Schäuble would be advocating this kind of position now. What's problematic is who gets to decide who falls in what tier. And the idea that Greece would be relegated to second-tier status after having joined first-tier institutions is, I think, somewhat problematic. And we're going to have to look at what the implications of that kind of relegation would mean in a club like the European Union, how that would pollute or poison relations between member states. I don't think we're going to have to look too far to see how problematic that is. All we have to do is look back at the fiscal debates of the early 2000s and the reaction of the Irish Taoiseach Bertie Ahern when he was reprimanded by the Economic and Finance Committee or the Council, ECOFIN Council, in February 2001, and you see almost immediately that countries don't like to be singled out, even on very minor infractions, let alone in this kind of big relegation situation. Then there's the French proposals that have been hinted at more recently, the creation of an economic government that will be capable of exercising much greater discretion at the European level. The argument there is quite an interesting argument. It's one that harkens back to that famous quote from Romano Prodi where he said the Stability and Growth Pact is stupid. What he meant is not that it's stupid. What he meant is that it is incapable of being used with discretion. Right? There's no choice. It's just a set of rules. And the economic government argument that the French have been positing all along is one that says we should displace this over or excessive reliance on rules and replace it with greater discretion, institutions that are capable of exercising greater discretion. To make that meaningful, we'll give them a big fiscal budget. To make it legitimate, we'll have a separate parliament. And in this way, we can have discretion at the European level. I'm not convinced that anyone in Europe really wants that kind of discretion at the European level or would be comfortable participating in those legitimating institutions. Even if that were the case, I'm not convinced that that's the appropriate response to this crisis per se, and I'll explain why that is in a moment. In any event, the responses that we're seeing from the institutions, from the Germans and from the French, right, represent a spectrum of different responses, but all of them actually have great roots in the past, and all of them, I think, underappreciate the uniqueness of the problem that we face in the present. We need to think about something different. We need to think about a more sustainable Europe. A more sustainable Europe that could, for example, allow Greece to default without forcing Greece out of the euro. What would be required for that to take place? What would be required to subject Greece, or any government for that matter, to the kind of market discipline that the bond markets were supposed to exercise without jeopardizing or threatening the viability of national banking systems? This is what the banking union proposals were meant to achieve, and so far they haven't really achieved that objective, and we need to figure out a way to make greater progress in that domain. We also need to figure out a way to think about Europe that emphasizes this kind of sustainability. If there's some terrible shock, how do we keep what we cherish about Europe rather than bringing ourselves to some existential moment in the way that we're facing today? I think in order for us to do that, we need to make three different distinctions. One is between what is necessary and what is optional, right? And necessary and optional I'll illustrate with the banking union and talk about what's necessary and what's optional in the banking union context. We also need to distinguish between different kinds of European commitments that are fixed and commitments that are revocable. And I'll use the contrast between the single currency and the single market to illustrate that dynamic. And finally, we need to distinguish between things that are technical and things that are political. And I'm going to focus a bit on Target 2, which is this very complicated payments mechanism, and on the principles of distributive politics in order to help you better understand that distinction. And once we're able to distinguish between what's necessary and what's optional, what's fixed and what's revocable, what's technical and what's political, then we can begin to design institutions that are more robust in the face of the kinds of shocks that we're going to confront looking to the future. And those shocks will be greater than the ones that we faced in the past. I think the volatility in markets is only increasing, and we should anticipate that. Well, let's talk a little bit about this distinction between what's necessary and what's optional. This is an argument that I've been having with Wolfgang Munchau about the nature of a banking union. Munchau's argument, and it's expressed quite clearly also by his whole Euro intelligence group, is that a banking union, in order to be effective, not only has to combine a single rule book, a single supervisory mechanism, some kind of resolution facility and funding, and a mechanism to bail out depositors, but because we're never going to build these mechanisms with sufficient financial firepower to contain the kind of crises that we're going to face, we need a fiscal backstop. We need a government that's capable of stepping in as a kind of financier of last resort to stabilize financial systems when the resolution funding is inadequate, when the deposit insurance is inadequate, and all the rest. Well, I think where Munchau and I would agree is on the need for these banking union aspects. I think where we would disagree is on the idea that you would ever build giant supranational fiscal institutions simply to have them as a potential backstop in the case some big crisis were to erupt, right? It seems like you're really over-egging it in that sense. Because once you start building these giant fiscal institutions, one can be sure politicians will find a way to use them for other elements. And I say this with a due regard to our experience in the United States. As a matter of fact, every time we build giant banking resolution funds in the United States, the first thing that Congress does once the crisis is passed is dismantle those resolution funds and put constraints on them so that they don't represent a pot of money that can be used for other resources, so that they don't distort the functioning of the market. So I'm not convinced that we need this giant fiscal thing. But I do respect the point that Munchau is trying to make about the need to bail out the banks, and so the question is, how do we do that? And there, what we need to do is to look in the United States experience and in the experience of other unified political entities and ask why it is that when subnational governments go bankrupt, subnational banks don't follow along at the same pace. And the answer is that subnational banks in giant federal monetary unions, or even small monetary unions like Austria, for example, don't hold the debt of their subnational governments as their collateral for routine treasury operations. Their asset portfolios are not polluted with all these instruments that we find on Greek banks, for example. Greek banks all hold Greek sovereign debt. They use Greek sovereign debt overwhelmingly, or Greek government-backed assets overwhelmingly, as the collateral for their routine treasury operations. So if you take down the Greek state, you take down the Greek banks. That doesn't happen in California. You take down the California state, you don't take down the California banks. If we could find some way for European banks to have other risk-free assets, a pool of risk-free assets that were not contingent upon the performance of their national government and its finances, then we could stabilize the financial system without this giant federal backstop. Now, the illusion here I'm making in not too subtle terms is to mutualize sovereign debt instruments or Eurobonds, an instrument that would allow us to achieve the same result without the giant federal fiscal architecture. In order to convince you that this is actually possible, right, and not some kind of pie-in-the-sky imagining, I guess I would just say you're all probably holding right now mutualized consumer credit instruments that are shared across individuals, irrespective of their income or creditworthiness. We call them Visa cards, right? And Visa cards as a technology are ways that we give you access to credit up to a certain threshold and allow you to use this for routine payments. And if you go bankrupt, it doesn't take down the visa system. There's no reason why the bankruptcy of a particular member state needs to take down a mutualized sovereign debt instrument. We just need to find appropriate ways to ensure their exposure to that mutualized sovereign debt instrument and then use that as the basis for replacing all the assets on the banking books of the financial systems of the diverse member states. And that will make them more stable in the face of the failure of one particular government to meet its financial obligations. We could talk about that a bit more, but rather than doing that, let's talk about fixed versus revocable commitments. This is what I wrote about in the blog on Monday, and the argument that I made is, look, the problem with Greece exiting from the euro is that the definition of a monetary union is irrevocably fixed exchange rates. And if Greece were to exit from the euro, then those exchange rates would no longer be irrevocably fixed, and the euro would exist as a fixed exchange rate regime. By the way, this is not me talking. This is Pierre Moscovici, who's the Commissioner for Economic and Monetary Affairs, speaking in Washington in April, who made the point quite explicitly, if Greece were to leave, we're never going to talk about Greece leaving, he said, because if Greece were to leave, that would transform the euro into a fixed exchange rate regime, right? Never has such a great hostage to fortune been delivered so easily. Now, obviously, that's not true, right? It's not like anybody in the UK looked at Scotland and said, if the Scottish referendum goes badly and Scotland leaves, and it leaves the pound, then the pound will become a fixed exchange rate regime and markets will turn on Wales and Northern Ireland or Cornwall or I don't know. That just was never part of the conversation. So obviously, entities can leave common currencies without destroying the currency that remains. Czechoslovakia is another example. The two countries split. Both countries were able to develop currencies in the aftermath. So it must be possible to do this. Nevertheless, it's why you leave and how. What's interesting in Scotland is that when Scotland left, it actually wanted to retain the pound. And the argument against Scotland was, we're not going to allow you to have the benefits of doing so. As an aside, when Slovenia left Yugoslavia, the Slovene president wanted to retain the dinar. He didn't want to have his own currency because Slovenia is too small to have a viable currency in international currency markets, and it needed some bigger anchor. Well, for Greece to be pushed out, that actually represents much more of a problem because it suggests a kind of a dynamic that markets can game. And when markets game this dynamic, then they can convert the monetary union into a fixed exchange rate regime. They can do that because they can do something in Europe that we can't do in the United States. They can go short on Italy and long on Germany. We can't go short on Mississippi and long on New York. If we did that, we would blow up the United States almost immediately. But they can because Italy and Germany have different sovereign debt instruments, and those sovereign debt instruments overwhelmingly reside in their domestic financial systems, all of which can be either shorted or gone long, and create the kind of flight to quality that is the defining characteristic of this market, right? So the basic point is that Greece should not be pushed out of the single currency because that would be a violation of what should be an irrevocable commitment, but it can be pushed out of the single market. As a matter of fact, that's what capital controls constitute, is the voluntary withdrawal of Greece from the single market. Greece is not unique in that respect. Both Cyprus and before that Iceland withdrew from the single market. These are revocable commitments because they can always join again once the conditions stabilize without undermining the performance of the single market per se, or at least not in any dramatic sense. So we need to focus on those fixed commitments and distinguish them from revocable commitments and put all the adjustment into the revocable category. And that's what we've been doing. The question is, how do we make that easier looking to the future? The final thing is this distinction between technical and political aspects of European integration. The reason I want to make this distinction is because the European Central Bank was supposed to be a technical aspect of European integration. It's become a very political aspect of European integration. But since the ECB is so obviously problematic, let's start with something really easy, like Target 2. Target 2 is an underlying mechanism for redistributing liquidity among the central banks that participate in the single currency. So that if one central bank ends up with too much liquidity, it hands that off into the pool, and if another central bank requires liquidity, right, it pulls it out of the pool. As an aside, we have this same system in the United States that operates between the different districts of the Federal Reserve System, and these inter-district settlement balances have been operating quite happily ever since the Federal Reserve System was created. That's what means that there is no balance of payments constraint inside a monetary union. You have instant and infinite balance of payments financing through the automatic redistribution of liquidity in this mechanism. That's a very technical mechanism. The question is whether this has distributive implications. In other words, can you win or lose by dint of this mechanism? That's the argument that Hans-Werner Sinn has been making quite persuasively in Germany, is that Target 2 is not technical, it is political. I'm not sure I agree with that argument. As a matter of fact, I know I disagree with that argument. I'm not sure I can explain why I disagree with that argument. It has a lot to do with the way we would account for the Target 2 debit position that Greece would leave if it had to withdraw from the system as a whole. But the point I want to emphasize is that by making Target 2 into a political issue, he actually began to undermine its function and to jeopardize the utility that this payment mechanism actually offers. Probably the most obvious example of that was in March 2012 when Jens Weidmann, the president of the German Bundesbank, looked at Target 2, listened to the arguments by Hans-Werner Sinn and said, oh, well, wait a minute, if this is a distributive problem, if we could be exposed to losses through this automatic redistribution of liquidity, then we should ask any country that wants to borrow liquidity from this pool to put collateral up in exchange for the liquidity that they borrow. If Weidmann had succeeded in putting forward this proposal in a serious way, he would have, in very precise technical terms, transformed the single currency into a fixed exchange rate regime, where your ability to stay in the regime was a direct function of the supply of collateral you had to meet the funding requirements you needed through Target 2. As soon as he issued this as an idea, he was immediately shut down because all the technocrats in the ECB said, this is crazy, don't do this. You'll undermine the technical functioning. We need to be very careful about these technical things because the technical things actually deliver for all of us, right? Target 2 is one example. Target 2 for securities, which just launched, is another. And when I say all of us, I mean both inside and outside the single currency. Target 2 for securities actually applies to countries outside the single currency. Of the initial participants, there were 4, one of which paradoxically was Greece. Of the initial participants, Bulgaria and Switzerland are outside of the single currency, one of which is outside of the European Union as well. So in that context, you get a clear sense of these technical issues. So let's protect the technical issues. Let's protect the irrevocable commitments, but let's be flexible on the political side. Figure out some way to manage the distributive politics, most obviously by trying to locate the distributive politics where politics works best, which means inside the member states themselves. And let's do that by focusing on what's necessary rather than trying to build what turns out to be optional. Unfortunately, having said all this, you realize, I've come to the end of my 30 minutes, this is a very complicated argument. And I'm not quite sure how to sell this complicated argument in terms that will be easy for national parliaments to embrace. I think one of the ways that we're going to have to do this is to begin telling a story about Europe that is not about the creation of a single political entity, an ever closer union per se, but rather about building resilience in the face of a very volatile and threatening, in many respects, global economy and security environment. And within that context, by focusing on building in that resilience, by paying attention to what's necessary, by keying on what we must do as a commitment and what we can opt into and opt out of without affecting the quality for everyone else, and by giving due respect to the technical and due legitimacy to the political, I think we can move beyond the kind of knee-jerk responses we've seen in the face of this Greek crisis. And we're going to have to do that because this Greek crisis is different from crises that we've had in the past. And if we don't respond adequately, it could be a defining moment in the history of European integration, and I don't mean that in a good way. Thank you very much.
Eric, thank you. We'll turn now over to questions. See, you did get to half an hour after all. Questions, please. Well, while people are... okay. Megan, I think you just beat the tape ahead of the gentleman, so if you go first, please.
Well, you mentioned that, Visa is a good example of how we could have Eurobonds. But realistically, politically, is it ever likely to come? delay?
I mean, it's all about how you tell the story, right? So prospect theory, framing effects. If we frame this story in the way it was framed immediately in Germany when we proposed the idea of mutualized sovereign debt instruments in March of 2010, the immediate framing in Germany was that's going to raise the cost of borrowing for the German state, right? Which is kind of paradoxical. The German state actually doesn't benefit from borrowing at negative real rates of interest or negative nominal rates of interest in short maturities. It would benefit from actually having higher rates of interest. That said, Visa doesn't necessarily raise the cost of borrowing for individuals. It makes borrowing possible and reliable. Visa is accepted everywhere. And in that context, mutualized sovereign debt instruments would increase the pool of liquidity and stabilize the European financial space. There is not enough in the volume of German assets in circulation to hold all the fear in European financial markets. So when European financial markets become afraid, when they go risk off, they buy all those German assets and actually do serious damage to German insurance and pension institutions. And Germany will be suffering for that for a long time in the future. So if we could just frame this as a way of making financial markets more stable, of protecting the returns on German investments, then I think we might be having a different conversation. But will we be able to do that? I don't think so, right? I wish we could, but I doubt it.
Okay, I've got three more names on. First, you, sir. Could I ask you please first to state your name and affiliation?
Ron Freeman, Atlantic Council. I didn't hear you mention the word growth, and we can both remember that Greece's economy, its GDP, used to be a growing economy. But the drivers of growth, consumption, net exports, investments, have dried up. There are states in the U.S. that don't grow very fast either. You mentioned Mississippi. But Mississippi continues to get an inflow of investments because it sells general obligation municipal bonds, which by U.S. law are tax-free. And tax-free is a great selling point to investors. Have you thought about something along those lines?
Do you want me to respond directly? Yeah, Ron, thank you. That's a great question. In a lot of the work that I've done, I went back and looked at the Greek case to try to understand what happened to the Greek economy under the euro. A lot of what we hear about what happened to the Greek economy under the euro is not what we see in the data. Greece was actually improving in terms of total factor productivity. It was improving in terms of real productivity growth. It vastly outpaced Germany on both measures. It was the second ranked total factor productivity growth country, which means it was bringing in lots of technology. The problem with the Greek economy was that all of the liquidity was evacuated from the economy when there was this flight to quality, right? When people became afraid of Greece. You can see this starting in March 2008. That was the first big capital outflow. It was around the Bear Stearns crisis when the European Commission first admitted that there were problems with Greek fiscal data. It intensified through the early months of 2009. It then abated after February 2009. And it abated after February 2009 because the German finance minister spoke to the FT and said no country in the Eurozone will ever be allowed to go bankrupt. And from that point, not only did Greek spreads diminish below Irish spreads, Ireland is a different case, but similar outcome, not only did they diminish below Irish spreads, but when the Greek government famously in October of 2009 changed hands from New Democracy to PASOK and admitted that its deficit was much larger than ever had been imagined, the spread differential between Greece and Germany was flat, and capital flowed into Greece rather than out, because everybody in the bond market was like, we knew they had a problem. Now they put a number on the problem, so we know how to trade on this number, and everything is fine. Where the problem started with Greece was as soon as the put was pulled off, when the Germans said, well, actually the Greeks are on their own on this one, and then in March 2010 they said the ultima ratio will only bail out the Greeks if they lose access to private capital markets. They ensured that Greece would lose access to private capital markets, and Greece had to be bailed out. Now, in that context, the question is, okay, well, why did Greece go from one situation to another? And this is the point that you're making about the tax exemption on municipal bonds. If you create a framework within which a country can borrow at privileged rates of interest, they can sustain a reasonable amount of debt, even on a relatively thin tax base. This is the experience of the United States. We have very thin tax base at the state level. and yet they can survive on a reasonably large amount of debt because there's this implicit guarantee from the federal government on the rate of return that you're going to get on your investment. The trick is to make sure that there's also a default risk. Right, so Mississippi didn't go into default, but lots of places in Alabama did, and I come from Mississippi, so I can look with some chagrin on Alabama. And looking at these places in Alabama, I realized that we have the best of both worlds. They're able to borrow in good times, but they're subject to market discipline, and in extremis, the investors will lose out, which is what Europe needs to have as well, the resilience to absorb that kind of default pressure without pulling all the money out of the Alabama economy along the way. Right? And that we don't have. What happens instead is that all the money gets pulled out of the economy, and then everybody goes, why isn't the economy functioning? Well, the fact that there's no liquidity in the economy is probably the first explanation.
Okay. Lady in the third row, please.
Rumi Bukuralska, I'm a journalist. I have two questions, if I may. First one is, wouldn't a currency board work in Greece in the way of establishing some kind of fiscal discipline, which is obviously badly missing in Greece? And my second question is, what signals shall we expect from Greece to show some elements of resilience so the national parliaments get more confident in their vote of supporting the Greek bailout?
Rubika, the first part of your question is actually really interesting. Currency boards only work if you have a balance of payments constraint. Because the function of a currency board is to make sure that you print domestic liquidity as a function of your receipt of international liquidity. But Greece is plugged into Target 2. It has no balance of payments constraint. It has instant and infinite access to liquidity from other parts of the euro area. So you can't have a currency board in that context, right? And so what you would have to do is to unplug Greece from Target 2. Well, that's what we witnessed in the last couple of weeks is when they put capital controls on the banks, essentially what they're doing is blocking Greece's access to Target 2. And the end result is the destruction of a significant amount of the Greek economy, right? So the unplugging from this technical substructure is actually quite a dangerous thing to do. It involves a very complicated transition process, and I wouldn't want to wish that on any country, right? I wouldn't want to wish it on any part of the United States either, to be unplugged from the Federal Reserve System. So, that said, I think you're asking the right question. How do we tell if the Greeks are actually behaving as a resilient polity as opposed to just a protest, almost failed state, right? Because the end result of fragility is that you become a failed state, right? Well, I think we have to have confidence in Greek parliamentary institutions. So far, nobody's mobilizing against parliamentary institutions. I think that's a good thing, right? I live in Italy where sometimes Beppe Grillo says things that sound alarmingly like a mobilization against Italian political institutions. I think that's a terrifying thing, right? But in Greece, that's not happening. We have seen Golden Dawn, but Syriza is not Golden Dawn, and Syriza seems to be able to exercise some discipline, so I wouldn't write off Greek democracy entirely. That said, we're conducting a natural experiment with the resilience of a democracy in the face of unending destruction of gross domestic product. And I'm not sure any democracy is resilient in the face of that kind of threat because of the way that political institutions operate. So I think we're seeing signs of resilience in Greece right now, but I think we're testing that resilience to the extreme, and I only hope that the world economy comes to bail out the Greeks. I was walking down here and I saw that the Icelanders are selling yogurt, or rather giving yogurt away. And maybe that will help the Icelandic economy somehow. Maybe the Greeks could do the same. But there's got to be some way to convert Greece into a trading country. Greece had an export to GDP ratio of about 22%, right? So it doesn't trade a whole lot. There were only 500,000 people working in Greek manufacturing up to 2007. By the way, it's the same 500,000 people that were working in Greek manufacturing in 1991, which is a testimony to the development of the Greek economy, and they were moving up the value chain, right? So Greece was actually doing well in preserving manufacturing employment, preserving export market shares, moving up the value chain, and then we pulled all the liquidity out and drove that right into the ground, and now we're asking how resilient the political institutions are going to be in the face of that. I think they're holding up remarkably well.
Okay. Gentleman in the front row, please.
Hi, I'm James Drummond from HSBC. You said that Greece's isolation at the moment is unique. and then you said apart perhaps from Cyprus in March 2013. Could you do a compare and contrast with the Cyprus situation back then for a non-European specialist? Why can they not bail out Greece or apply the same structures that they applied to Cyprus?
So Cyprus is cool because Cyprus is like anti-Greece, right? So in the sense that Greece, you have a sovereign debt problem that has morphed, because we've morphed it, into a banking problem. And for the last 6 months, I've been arguing, don't pay any attention to sovereign finances anymore. Pay attention to the banking system, because the banking system is the weakest link in the chain. But the Greek banks weren't bad. The Greek banks were good banks, right? It's just that the Greek banks all passed the stress test and the comprehensive assessment that the ECB just did. So as of December, they were solvent. They're not solvent anymore. They were destroyed systematically by pushing them into emergency liquidity assistance, by forcing them to rely excessively on government-backed assets for their collateral in order to gain access to liquidity, and over time by strangling all the other assets in the Greek economy, and so increasing the NPLs up to over 40%, right? So if you want to destroy a banking system, there are ways to do that, and we've done that quite efficiently in Greece. In Cyprus, they had a banking problem, right? They had these giant banks that, interestingly enough, speculated on Greek sovereign debt instruments and were using the remuneration of Greek sovereign debt instruments in order to pay off the very well remunerated deposits they were taking from the outside world. They also had the most conservative liability structure of any financial institutions in Europe. They were all deposit-based, right? There was very little junior debt, very little senior debt. It was all deposits. And that represented the problem, right? Because as on the asset side, their assets went belly up. If you look at the Cypriot experience, which you'll find is in March of 2012, when Greece goes through the second bailout, all of the Cypriot banks, but the two big banks in particular, get pushed into emergency liquidity assistance because their asset portfolios collapse at that instant. And the Cypriot state was trying to find a way to bail out these institutions, but it couldn't do that without crushing the Cypriot economy. So the state's finances were okay, but the banks were bad. In Greece, it's exactly the opposite. The banks were okay, but the state was bad. And what we've learned in the contrast between these two experiences is if your state is okay, you can survive really bad banks as long as you can bail in the depositors, which is what they did. Try not to do the first suggestion from the ECB, which was to bail in the depositors under 100,000 euros. So stick with the large depositors, but if you stick with the large depositors, then you're okay. As an aside, Cyprus got out of its capital controls in 2 years. Iceland is still struggling after 6. It's great to be in a single currency. If you're in a single currency, then your liabilities are all denominated in your asset-denominated currency. So you can resolve all these problems. Once you release the capital controls, you're fine. Whereas in Iceland, they're sitting there going, oh no, if we release the capital controls, then everybody who's holding assets in Iceland knows that the Icelandic kroner is going to tank as they try to liquidate those assets all at the same time. So they're all going to liquidate those assets at the same time as a consequence. Terrible to be in an own currency environment if you have to put capital controls into place. Much better to be in a single currency.
Right, I have 2 questions back on this side of the room. First, lady.
Yeah, I'm Katrin Rubel. I work for German newspapers as a journalist here ago. How do you evaluate the impacts of the Greek crisis and the recent developments within the Union actually on the UK and this whole Brexit debate? I guess that was also a big thing in Brussels to kind of show the UK, you don't want to get rid of anyone. So, how would you evaluate this?
So, okay, on I'm speaking to an audience full of experts on British politics, so I'm going to be very bashful about this. But the basic point that I would make is, from a continental perspective, you look at it and you go, oh, wait a minute, if Greece gets pushed out of the euro, then Britain, David Cameron, gets a free hand in the negotiations because they're never going to push out 2 countries, right? So David Cameron wins because he has the, you can't lose me after you've lost Greece card to play. He doesn't have that card, obviously, because Greece has been kept in, but he might get that card at some point in the near future, so we'll have to wait and see. So that's one way of looking at it. If you actually live in the United Kingdom, I suspect one of the things that you're going to look at is go, how do I mount a coherent argument to defend participation in a European Union that seems to handle crisis so poorly and to express relationships between member states that are so vituperous, right? That are so conflictive. This is a really hard sell, right? This is we really need to be in this organization that treats its members badly and that can't get organized in the face of a crisis. So that would seem to be, candy in the hands of UKIP, who could say, let's get out of the EU because the EU is incompetent and because they're conflictive and it's a dangerous place to be. Look at what the Euro did, right? At the end of the day, I don't think the British people are going to be persuaded by either of these arguments. I think the British people actually are quite sensible on the issue of Euro membership. So we might get some changes in the newspaper coverage and we might get different narratives that emerge. But in the real court of public opinion, I think we have a very different conversation that's taking place. And that conversation, I hope, will be able to surface and be dealt with, because this conversation about Greece and Brexit, I think, is a distraction from that much more important debate. 20 years from now, the decisions that they make about that more important debate will still matter. 20 years from now, hopefully, this Greek situation will be something that's only taught by people like me in the classroom, right?
Lady in the aisle, please.
Now, this is going to be slightly crazy. It seems to me, I work in the Middle East, okay? It's Barbara Allen Robertson, formerly of Warwick University. It seems to me that there has been a number of things happen, and it's in this more simple level than what we've been talking about. There's seems to me to be an equating of individuals' finance with the state. That when the state's out of debt as an individual, however you manage to do that, and the state should be, it is operating like an individual. This resonates with the U.S., I think. It's sort of discussion you get in the public in the U.S. But so let me just move on slightly, that with regard to Greece, Syriza was seen as reliable or trustworthy by the Parliament because they saw their leader, the leader, as not corrupt, not part of that corrupt elite. That his decisions were on the basis of what he had been elected to do. And so when he found he had to present a budget to the powers that be, well, he did it, apparently with the help of the French. So, and then the IMF weighs in and says you can't do to Greece what you're trying to do. So it seems to me that there's a number of different things that feed into this, and I'm just wondering what your view is. I mean, I recall reading several people saying that, well, they trusted the leader of Syriza because they knew he was clean. They don't know that any of the rest of them are clean. And so that was...
Barbara, I think these are both really interesting and important themes. I should say that as somebody who lives in Italy, I'm not very familiar with corruption among political elites, and so actually, look, on the first point that you're making about the comparison between states and households, this is actually the most important category error in the whole European debate. You cannot force an individual to borrow. Very difficult, right? I mean, you can tempt them to borrow, but you can't force them to borrow. By contrast, you can force a country to borrow, right? It's very easy to force a country to borrow. If you liberalize capital markets, all you have to do is just go in and buy any marketable asset, right? As a foreigner, if I go in and buy Greek sovereign debt instruments, I am forcing the Greek economy to borrow my money, right? And that's how it's going to show up in the accounting. Now, obviously, the Greek economy benefits from this, but think about the poor people who actually are trying to save money in the Greek economy. They're going to see the yields on their investments go down, and they're going to get priced out of their traditional market. So Greeks that used to make a lot of money by buying Greek sovereign debt, nobody ever, right, had to buy anything else in Greece, suddenly had to make their money by investing in other things in Greece, So they actually invested in firms and they invested in houses and real estate. We saw this across the euro area. And so what we did is we pushed all the risk onto these locals, right? We foreigners. Foreigners in Italy, for example, Italy has just over 2.1 trillion euros in sovereign debt instruments in circulation right now, right? And it's about 123% of GDP. In 1991, 6% of Italian sovereign debt in circulation was held by foreigners. By 1999, as a result of capital market liberalization, 27% of Italian sovereign debt was held by foreigners. By 2007, 46% of Italian sovereign debt was held by foreigners, right? And the reason that's important is because all those Italians were pushed into investing in other things, right? And the foreigners held Italian sovereign debt. It's also important because in June of 2011, the foreigners looked at Italy and they said, well, wait a minute, Greece is about to go into a second bailout. Private sector involvement has just been invoked. And even though Italy seems solvent and it has a relatively stable government, my exposure to 2 trillion euros in marketable instruments, right, which I, as the collective international community, hold almost 1 trillion euros of, the probability of them going bankrupt may be small, but my exposure is so large, the expected value means I have to redistribute my assets. So you see from 1 month to the next in Italy that Italy's target to balance is 8 billion euros in surplus. By August, that's in June, by August, it's 100 billion euros in deficit. That's all the foreigners selling these sovereign debt instruments into the market, right? And by November, they crushed an otherwise stable government. Simply by dint of making the Italians borrow this money and then selling out those investments and pulling the money out of the economy. So this is a very important dynamic that's misunderstood if you try to pretend that Italy is a household, right, that can borrow responsibly. It has nothing to do with Italy being responsible. It has to do with capital market liberalization and the volatility that represents. Now, within that context, the question you have to ask yourself is, well, how does anti-elite politics factor in? The neat thing about Silvio Berlusconi, right, I said it was a relatively stable government. From 2009 to 2011, Silvio Berlusconi was embroiled in a number of salacious scandals, right? Some of which were fiscal, some of which were personal, but all of which were interesting, right? And yet nobody in bond markets cared, right? This was a guy who made self-interest the reason of state, right? And nobody in financial markets cared. But when financial markets suddenly turned on Italy, then everybody started to go, oh, well, Silvio Berlusconi's corrupt. Oh, all these Italian elites are corrupt. Oh, let's vote for this comedian named Beppe Grillo and the Five-Star Movement, right? And there's a huge explosion of support in anti-elite politics. Does the Five-Star Movement offer a superior form of government? No. Should we actually discredit the whole of the Italian ruling class? No. And this is where I think we need to look at the Greek situation. Greece and Italy are a lot alike, right? They have problems collecting taxes. There's corruption. Italy has more organized crime than Greece does. I think organized crime is too complicated for Greeks. But bottom line is, you know, these are places where they actually have real public servants, people who care, really smart academics and policy advisors. And this anti-elite politics denies all of that. One of the worst things that Yanni Varoufakis used to do, and I just hated it, was he would come out and he would trash Greece to international audiences. He'd say, oh, we're bad, because that was part of his anti-elite message. But the Greeks aren't bad. They're hardworking. They work more hours than anyone else in the euro area on an annual basis. They have longer working lives than you could possibly imagine. They qualify for retirement and they stay in the workforce for, on average, 4 to 5 years. And all of that is dismissed in the kind of anti-elite rhetoric, right? And I think that this anti-elite politics is very problematic for the way we address these crises as a consequence. But it is ubiquitous, right? Anti-elite politics is not just a function of Italy and Greece. You find it in Spain, obviously, but you find it in Ireland. Why is Sinn Féin so popular suddenly? If it weren't for an anti-elite message that it's been promulgating, that's finding quite a lot of resonance among the electorate. Yes, please.
Hello, I'm Yuki Honishi from Kyoto News, Japanese news agency. I've got a question regarding the bailout program that Greece was forced to accept. Do you see it as a good? Was it good? Was it a bad deal for Greek people? And if you do have, what would be your ideal bailout program in Greece if you were a creditor thinking about Europe?
So, and I think this is a really good question. But in late 2009, early 2010, I sat with Dana Allen, who's the editor of Survival, and reassured him that there was no way Germany was ever going to let Greece go bankrupt, right? And when Germany did that, I wrote an article in Survival that was called Merkel's Folly that said, by letting Greece go bankrupt, the Germans have cost themselves and Europe an enormous amount, right? This was a terrible policy error, completely unforced. So my first preference would have been for me to be right in 2009 and for Germany not to let Greece ever go bankrupt, right? Because Greek debt was sustainable, right? For those of you who are wonkish, when the Papandreou government asked for the bailout, the bond that it could not roll over had a coupon that was higher than the yield trading in the market. In other words, it couldn't not roll over this debt because it was going to be too expensive. It was already paying a coupon that was higher than the yield in the market, right? In non-geeky terms, what that means is that they were actually still going to be able to turn over this bond for something that was cheaper, right? This is a 10-year-old bond from the beginning, right before Greece had joined the euro. And so they could afford it, but they knew, intelligently enough, that they wouldn't be able to afford it for long. And nobody wants to have a failed rollover in the market, right? And nobody wants to try to issue new debt to retire old debt and then find nobody take it, right? And that's what Greece faced. It wasn't that they couldn't afford it, it's that they risked being shut out of the market altogether. And once they got shut out of the market, then the question became, okay, how do we get them to pay this off? And the answer should have been, you give them the income, they pay off the debt, right? But instead, the answer was, you give them the liquidity, you charge them a high rate of interest, and then you let them figure out the rest, and we'll give them tight conditionality in order to help them in making the right choices about what this rest entails. We've been following that experiment now for 5 years, and it has failed to generate sufficient income for Greece to be able to pay off its debt, even with a significant reduction in the net present value of Greek obligations, right? They can maintain the liquidity, right? Well, now they're illiquid completely because they've been shut out of the markets again, but they could actually meet their interest rate and amortization obligations, but at the end of the day, they were just never going to be able to get sufficient access to private capital markets to do that on a regular basis. So they keep facing this threat of a failed rollover, at which point you should just write off the debt, right? In other words, reassure the markets. Or put a put on it and just say, we guarantee all this debt. It's going to be paid off, right? And then give the Greeks the opportunity to grow. But if we don't allow them to grow, if we don't give them the income, then don't be surprised if the debt is unsustainable, even with successive workouts. So, short answer to your question, I don't like this deal, right?
Are there any more questions? Last one.
Yes,
Lady by the mirror, please.
And I wonder, the news we have seen from Greece last month, do you see that this would be repeated in the foreseeable future? We again have closed bank, again have the new bailout, again a hard discussion.
I think that's a really good question. I mean, obviously the European Central Bank has a critical role to play in this, because the European Central Bank can sustain the Greek banking system. And the Greek banking system is failing not because the banks are bad, but because the sovereign entity, so the Greek government, is bad, and that's underwriting all of their assets, and because the Greek economy is doing badly, and that's underwriting whatever assets they have that are not. So you get the picture. Now, in that context, I haven't seen anything that makes me believe that the sovereign entity is going to do better, right? And I haven't seen anything that makes me believe that the underlying economy is going to do better, right? I wish that were not the case, but we need some deus ex machina to come in and sort that out. If that deus ex machina does not come in, then I don't see any reason to believe that the banks are going to be better. What we're going to do is do the Spanish thing, right, where you take the banks and you just keep cobbling them together in order to try to create some kind of balance sheet that looks viable at the end of the day, stripping off bad assets along the way. But what you're going to end up with is a pencil-thin financial institution that's not capable of operating payments for the whole of the economy. That I think is an unfortunate end product, unless somebody else wants to come in and do this finance for them. So I think we need to think a lot more carefully about the banking resolution strategy than we have, and also about the role that the ECB is going to play in it. And I think that conversation is probably taking place right now at the ECB. As a matter of fact, I think it just started, or it's going to start in about 30 minutes.
As they start, so I'm afraid we must conclude. If your tastes range beyond Europe, we have a talk tomorrow by my colleague Rahul Roy Chaudhry talking about the Narendra Modi effect on India's foreign policy. At same time, same place. All it remains is me to thank you very much for coming, for your very intelligent questions, but mainly thanks to Eric, who really gave an excellent presentation and engaged fully with your question. Nobody can claim their question wasn't answered.
Thank you. Thank you so much. Really appreciate it.